Hey everybody, this is Brant from Wolf on Wall Street Trade with a market update for the week ending August 30th, 2019. I'm going to keep it a little bit brief because I am in South Florida and we're on again, off again with this Hurricane Dorian. So S&P 500, after 4 weeks of being down, it was up this week, and you can see 2.8%, roughly around 3% for all the averages. You can see 3% for QQQ. So what I'm going to do is go over a couple changes this week, mostly in S&P sectors, and then I'll, at the end of the video, kind of lay out what I think could happen into next week. So let me jump to a daily chart, and let me put some trend lines on here. This is going to be a little confusing at first, but what we basically have, if I back this up just a little bit, is this. This is the year 2019. Here is the July range and the breakdown in early August, and this big range that we've been in since really the first week of August. I had been preparing my subscribers for the last 3 or 4 weeks to be ready for something like this big, choppy, volatile consolidation range. It looks a little bit like the one in 2018 around November, where you had a first leg down here, a big choppy consolidation range, and a second leg down. But you can see this one's even more compact, making it a little bit more difficult for swing traders in here, because you really have to have a 5% stop. The market goes from very, very ugly one day to very strong the next, and then it reverses. So when it gets up here, the bulls get excited and they start buying, and then the market reverses and the shorts come in and then they get slaughtered. So you really have to look at this in the context of the entire price trend of what's going on here, and just expect that this is going to continue for the time being. In my view, these are bearish consolidations. You have a first leg down here, and this is basically a lateral or sideways range, like a rectangle in the S&P. You could draw it a few different ways because we do have some slightly higher lows over here. But if we look at the rest of the averages, you'll see there's a wide variety of different patterns going on. So the nuts and bolts of it: the top of the range, the bottom of the range, 2900, where there's been a lot of reactions, and this is a little downtrend from the end of July. So let me go back to the 60-minute chart, and here you get a better look at it. 2900, a lot of reactions here at 2900, so it's an important psychological level, and the top of the range here, and this is the downtrend from late July, which is where I originally thought the S&P was going to end up a couple weeks ago. This week on Thursday, Friday, I thought it was going to come right to 2930. Where this trend line and this trend line converge. That's basically what it did. So you have a big range here from about 2822 to about 2844, and a particular range of resistance here around 2930 to 2944. Coming into the week, remember the market was down big last Friday, and it was indicated to open about 1.3% lower on Monday. It didn't over here. So I expected that we were going to get something called a whimper rally, which would basically be a small weak rally in here, like we started out Monday and Tuesday, within Friday's range. So on a daily chart, Monday, Tuesday, Wednesday, we were within that range. That was what a whimper rally looks like. Again, I covered that last week in the video. We had one of those in November, right before the second leg started down in December. So that's what I was expecting, but when futures opened Sunday, what happened was President Trump said that China had called the U.S. and wanted to restart trade negotiations, but it was untrue. So the market would have opened up down 1.3% on Monday. Instead, it opened up over here. And this is what it looked like the first 3 days of trade, consistent with a whimper rally. I actually went short some QQQ right over here. And anyone that says, the stock market is good at discounting everything that's known out there, it's not true. The bond market is much better at discounting. Stocks bought that coming into the week. Bonds did not. Once that story started to come out that it was not true, and a staffer basically leaked that to the news and then got fired the next day, bonds were not buying the story. Stocks were. Stocks were still ready to rally. And we still have something like a bear flag here, but it's a little bit stronger than I wanted to see for a whimper rally. S&P is more or less in a lateral range. That is bearish. QQQ, now it has been in more of a bear flag. Okay, this is the flagpole, this is the flag, except these last two reactions didn't make it up to the top. So I may revise this into something more like a triangle, but it would still be a bearish triangle, because a triangle on its own, a symmetrical triangle, has no bearish or bullish bias. It depends on the preceding move, which was down, so that would give it a bearish bias. But for right now, I'm going to see what happens next week. I'm going to keep this bear flag because I see a lot of them all over the place. Going to the Dow or the diamonds, I have two interpretations of this one. One is like the S&P, which is pretty much a lateral range. And maybe we made a false or failed breakout attempt here on Friday, closed back below it. And my other interpretation, I'll go to the Dow for this one, is more of a broadening range. So this looks like a right angle broadening range, which is not bullish. And the fact that we do have a little higher high here means that I might raise this trend line up if there's more evidence for that next week. And we'd have a broadening range, which makes perfect sense. A broadening range is a chaotic market that's being whipped around by wild rumors. That's pretty much what we've had the last 4 weeks. And then we have small caps. So IWM small caps, here's the July range. False breakout, failed breakout leads to quick reversal here. You can see a little bear flag there. Now, unlike NASDAQ, which has been trending in a bear flag, S&P and Dow, which have been more lateral, small caps have been trending down. So if you look at the performance on the month of August, the S&P is down about 1.75%. IWM is double that. It's down near 5%, and you can see why here, because it has been trending down. Small caps tend to lead the broader market, so this is a bearish development. Let's run through the 11 S&P sectors real quick. It'll give you a little bit more information because these are the sectors that make up the S&P 500, and a lot of times they will lead it. So first, the most lightly weighted sector is the material sector. It's trade sensitive. Again, I have that same kind of downtrend that I have on the SPY where it has met resistance here a few times. So we have two kind of different price patterns here. One was a wedge that it kind of broke out this week. So that would be a bullish development for the material sector, but it could still move into a lateral range, kind of like the S&P. So I have this trend line drawn in for a downtrend channel, which intersects with some support and resistance over here. So we'll see what that does next week. You know, if it breaks out above here, then we'll start seeing a little more positive bias for the S&P 500. But this is a very, very lightly weighted sector for the S&P. Then we have the energy sector over here. So again, that same kind of downtrend line from late July I have drawn in here. So in my mind, you know, XLE, the energy sector, could go up to about $61 and still be in a very bearish trend. It kind of looks a little bit more like a descending triangle. It was starting to look like a downtrend, like small caps, but it made an equal low here. So it looks like a bearish descending triangle after this decline, bearish. And the financial sector did pretty well this week with some curve steepening. So it too was in a downtrend like small caps. So it could move back into something more lateral like the S&P. That's why I have this trend line drawn in here around 27.25. We'll see what it does next week. And for the industrial sector, which is very trade sensitive, okay, we basically have the same thing as the S&P, kind of a lateral range, and it's meeting resistance there Friday. If we jump to Dow transports, which are part of industrials, here's the consolidation range. So it was looking like a downtrend too. Now it's moving into a right angle, broadening formation, psychological support resistance here at this 10,000 level. It's been an important level the last couple months. And let's go to technology. This is the most heavily weighted sector, the most important, the most influential. Again, it looks like NASDAQ, QQQ, with a bear flag. This is the prior week's range that it had kind of gone up and hit this bear flag top and moved down to this week. So bear flag. And so here's semiconductors within technology. Same thing, bear flag. Okay, here's the flag pole. Here's the flag consolidating against the prior trend. And I've been talking about the defensive sectors, the 3 defensive sectors outperforming. You'll see it here. This is consumer staples. Look at this. This is from August. So it hits this big trend line that's been holding all year. Bull flag, new record highs over here. So it has been trending up while everything else has been going down or sideways or bear flag. Utilities have been spectacular, defensive. Again, this is what I've been saying, these defensive sectors making all-time new record highs. Utilities, this is August. This is what it has been doing. And healthcare, a little bit of a complicated trend here, kind of a descending bearish triangle it broke down from. It's kind of forming another one here through August. So a lot of consolidation in all the sectors. The cyclical or risk-on consumer discretionary sector, I have the same downtrend line as the S&P drawn in here from late July, which converges with what is a broadening range. You have lower lows, higher highs. This is basically what we see on the S&P 500's chart. Broadening top from over here in January 2018. And then we have the communication sector, pretty much in like a descending wedge. Here's the longer one, the same trend line I connected from late August in the S&P 500. And then the last sector, the real estate, another defensive sector, one of my favorites. Been talking about this one for a while, heading up to 39.50. This is what it has been doing. So all of your defensive sectors have been acting well, moving higher. That is utilities, consumer staples here, and again, real estate. So it tells you that the market is very defensive during the month of August. And if we look at volume on any one of the major averages, the volume is consistent with a bear flag here too, or a bearish consolidation. The volume is falling off as it should. So keep an eye on those sectors, how they develop, all the averages, but also keep an eye on other things like the treasury market, the bond market, rates, and especially currencies. I've been talking about this for months. The three pairs I've been watching is the Aussie versus the US dollar over here. You can see it is at the bottom of this range. This was when the market sold off last Friday. This was the end of the August sell-off. So if it goes up, it's more bullish for stocks. If it goes down, it's more bearish for stocks, especially because it is sensitive to China, it's sensitive to Asia, and the trade war. Another pair is the dollar yen. And it too came down with the entire market here in early August, has been consolidating sideways since. This is last Friday, dropped below that, and it's kind of in the middle towards the upper end of the range. I have it labeled basically 105.50 to 106.75 over here. Again, a move up is bullish for stocks, a move down is bearish for stocks, especially if it is leading. And then because everything in China is such a big deal right now to the trade war, I've been watching the dollar versus the yuan. Escalation above 7. This is when the trade war really escalated. Stocks fell off. So basically on this one, if it goes lower, it's more constructive for stocks. Higher, it is not good for stocks. So it was sitting here pretty much at the highs this week because we just came out of that trade war escalation Friday here. And then Friday afternoon, it started to ramp up. And I think that was maybe because we were going into the weekend. Chinese troops entered Hong Kong last week. The market didn't pay any attention. The bond market did. Stock market did not. I think it was moving up here in anticipation of potential trouble over the weekend between protesters and the authorities. So I watch a lot of these, but these are the three pairs that I think are really crucial, critical, and have led the market. Nothing about the trend line for the year of 2019 has changed. S&P is consolidating below it. It broke the trend line in early August, consolidating below it. NASDAQ is consolidating above it. Now, I could fudge this trend line and draw it down here like the S&P. I think this is just a better trend line that captures more reactions. So on top of it, and small caps, remember they lead the broader market below. So I'm going to show you one more thing, the 3C chart. Let me jump back to SP 500. And what I want to focus on is where we would see buyers at the bottom of this range. So at these reactions, we're going to look at 3C and see what it says. So this is the SPY, 5-minute. Takes a little bit of the noise out from the 1-minute charts. Good strength coming into July from June. June was very strong, no complaints about it. But July, we saw these negative divergences leading prices lower. So this is the consolidation range of August, almost 4 weeks. And what I wanted to point out was just like the falling volume, we can see 3C really has a lot of energy on these first two bounces. We went long this one, traded it up to here. Then I went short here and traded down to, on this one. So both of them, pretty good energy right here, as you can see. Coming into this week, not the case at all. So volume is showing less conviction among buyers at the low here, and 3C is showing the same thing. A little closer view, you can see what I'm talking about. Positive divergence here, good strength off the low, then negative divergence up in this range. So this is coming into the last week. Not a good positive divergence, not good energy, not enthusiastic buyers, and started to dip down Thursday and Friday, kind of like it did back here. Let me touch on one other thing before I wrap this up. Crude oil was the most supportive risk asset for the S&P 500 this week. That's a 60-minute chart of USO. So it acted better coming into this week over here. It did not touch the bottom of this downtrend and gave support to the energy sector, which gave support to the broader market. On Friday, it closed below. So this is another one of those trends I might revise like a descending triangle. Okay, so this is the May high in crude, and this is what it has done since. So the stock market was going this way, crude was going that way. So this is a pretty defined trend here. So I'm going to be watching this because crude, without a doubt, was the most supportive aspect for stocks this week. Heading into next week, which is a holiday shortened week for Labor Day here in the US, I have no objective evidence to say, this is a probability. It's just a gut feeling. So we have this very clear consolidation over the last 4 weeks or through the month of August, as you can see. So I'm watching different traders on Twitter. Now, everybody is posting this. Everybody sees it now on CNBC. The chart master is now showing charts of this consolidation. I think there is a decent probability that because this is so defined, we may see a head fake or a run on stops. This area of resistance here around 29.44, that could get taken out with a move above, get all the bulls to jump in, get all the shorts to cover, and reverse. The 50-day moving average here would be a perfect area to run all the stops. Price breaks out above that. It gives the big guys a lot of demand to sell into, and a reversal back down. This is the IWM 60-minute chart. So look at July. Very, very tight range. Kind of a situation like we have now. Very defined. Everybody knows it's there. And you have these two moves, one below and one above. And I think this is the most effective version when you run the stops below and above, and then it comes back down. And from failed breakouts come fast reversals. So that is a scenario that I think we could see. Again, I have no objective evidence to say that. It's more of a gut feeling just because this is so defined and everybody sees it now. One of the reasons I think it would be a head fake or a failed breakout is because there's just no energy in the charts down here. There was earlier in this consolidation. Here's QQQ. It's probably even worse than SPY. 3C has been really lagging up here at the top end of the range, making lower highs and lower lows. And IWM doesn't look much better. It really started to turn up here in this range I just showed you. There's that false breakout. 3C did not confirm, and we see lower highs and lower lows in 3C as well. If we had strong buying off the low like we saw here and here, then it would be a different situation or a different scenario. And from a broader perspective, this broadening top is still in place in the S&P 500. This is a 2-day chart. You can see the consolidation we're talking about right here. So that is going to do it for this video. I hope you enjoyed it. If you did, please give it a thumbs up. Feel free to share it. And I believe there's a subscribe button down in the lower right-hand corner. Market is closed Monday for Labor Day in the U.S.